Just getting this up and running. Hey, Dork. Still no JFresh. How's everyone doing tonight? Wow, faces. Oop. Okay. Good evening, guys. Nice. Make sure pen is working. Target. Okay, cool. Got that functioning and okay. How's everyone doing tonight? Hey, Gorilla Mode. Let's get the party started. Big old heart-ons for all. Thanks, man. Just waiting for one more, and then we'll get the party started for you guys. Just getting everything set up and ready right now. Oh, get that zoom up. There we go. Okay. Mm, cool. All right. So, all right. Cool. All set. Dork, are you gonna unmute your mic? We can at least back and forth a little bit with before JFresh gets here. You have YouTube chat to the plebs. I haven't learned anything yet. It's liked. Thanks, Clued Calls. I appreciate the immediate support. Are you gonna super chat Gammastrike? Don't. Oh, you can't. Actually, it's not monetized. Boom. Got that live. Got the stream up and running. Whew, that is a bit heavy. I'm gray. This is weird. Well, there's no memberships on the other one. Guess we'll just let some people filter in a little bit, and then we'll get this started as soon as JFresh shows up. Yeah. Start talking. What his kittens probably pooed in the hot tub again? I don't know. He has like 14 dogs and 12 cats and like 35 children, so it's hard to know exactly what's going on at his house, but I assume it's pure chaos. No worries, clued in. I appreciate it, man. Dork? Are you doing the. Can you guys hear Dork? Probably not. Dork audio only on Discord? I can't hear Dork at all. Thanks. Dork was focused. Dork's fixing his audio right now. It's going to be just a second. Hey, Dork. Hmm. Nope. I can't hear him on here. I don't know how you guys can hear him. Hold on, let me try to leave and rejoin. Can you hear me? There we go. Now I can hear you. What a pain in the ass. Yeah, I just had to do the same thing. All right, cool. Awesome. Do we know what's going on with JFresh? Has anybody heard from him? Apparently. All right. Well, I guess I'll show up to the event that he wanted to start. He's been on Twitter. Of course he has. Fantastic. When was he last on Twitter, NW? I want tabs. Yeah. You guys sound like you have $10 mics. You have $10 mics. These are like Sures. These are nice. These are nice mics. Oh, maybe your connection's bad. Shouldn't be any quality drop. You sound good to me, Dork. Oh, there he is. Hey, look who showed up. Yeah. Well, we're doing Greeks by strike tonight. What? Oh, they can't hear you. They can hear me.
Yeah,
there
exactly.
we go. That should fix everything.
Right.
What about me?
No one cares about that part.
Yeah, they can also hear you.
Everybody good?
Yeah.
We everybody everywhere now? Thank goodness. Okay, cool. Well then, now that we've got our resident lecturer, then why don't we kick it off?
Yeah, I'm ready.
So first off, let me just say, just to give everyone what idea what we're doing here, it's a ground up explanation of the Greeks. Well, just of all the tools we have for Gammastrike. just kind of going through things, giving a basic overview one by one through all the different features. If you want to read or if you want to hear more about what we did, how we got here and all that, just watch the last video. We did way too long of an intro, and ask questions all you want. Our production bitch Ron is in the background dutifully writing them down, and he's going to bother us with them throughout the night. So do ask, and we will answer at the end of the whole thing. There we go. There's the intro.
All right, are you guys ready for this? This page shows all of the Greeks for an options chain by strike.
It's revolutionary.
It is. Well,
not only by strike, but also by
expiration. Yeah.
Yeah.
I want to start off with, this is, I know it looks simple on the surface, but this is probably the tool that was the biggest pain in the ass to build outside of live data. It is actually, although just, bars on a chart and just a graph, quite complex, and there's a lot of ways to use it. There's a lot of different filters. I guess, do we want to start off by going over each of the Greeks and what their relevance is? Obviously, up here at the top, you can see that you have some filters. You have delta, gamma, vega. You have OI. You have charm, speed, vana, and volume. So I think maybe best, I think everyone knows what open interest and volume are, but maybe we should go over delta, gamma, vega, charm, speed, and vana real quick, and just kind of cover the...
Maybe first we could go over the expiration slider and the expiry button just to show those real quick, and the calls puts net button, and then we can get into those for sure. But I want everyone to watch these dance around.
You want me to just kind of go over like the functionality bits before we get into the...
Yeah. Well, give people an idea. Watch it dance around.
All right.
There's two ways to approach this, right? One is like show everybody kind of what it does functionally, and then explain why it's valuable. Or explain the value of the data and then demonstrate the functionality.
I just think functionality will go faster. That's why.
We're going to be doing this for like an hour or two. So, well, I don't know what you're trying to rush.
I'm just saying we could get it out of the way so that way when we click around on things, it doesn't throw people off. I mean, so we got the strike button in the middle there. That also, if you click that, it switches over to by expiration.
Let's start with delta, gamma, vega over here. Jesus Christ! All right, just stop. So you have your different Greeks, first, second, third derivative, and you can kind of just click between those and sort by those various Greeks. You have OI, which is the total amount of open interest on each chain at each strike, sorted by puts and calls, and then you have volume, which is going to be your volume for that trading day. This is one of our overnight pages, so it's going to update around 6:30 to 7 p.m. Eastern each night, and then it is also going to update around 7 a.m. Eastern every morning. OI, this is the OI update. OI will update in the morning before market open, and this will change. So if you've done analysis the night before using this tool, remember, and this is true for all of our overnight tools, remember that it will change in the morning, and you may have to revisit that analysis before market open. Here in the middle, we have calls, puts, and net. This is pretty self-explanatory, but if you don't get it, you can filter all of these individual things by calls. You can filter them by puts. You can look at both puts and calls simultaneously, or you can look at the net value, which is the combined put and call value at each strike. Most often, you will see us display the net values, but there is definitely value in looking at at the gross positioning. Up here on the top right, we have trade date range and expiry. So this tells you what the expiry we're looking at is. Right now we're looking at 4.42. And we're looking at this is most up to date as of market close today. Tomorrow's being a holiday. What you can do with this is you can click backwards, and you will be able to look at the prior day's close, and then the day before that, and the day before that, and the day before that. So this lets you kind of go back in time and see how positioning has evolved. And then lastly, as far as navigating this page goes, we have expirations. You'll be able to sort the chain by removing future expirations from the chain. So you can look at Monday's expiration, Tuesday, Wednesday, Thursday, next Friday, and then so on. And you can add those or remove them all as you see fit. And that allows you to kind of trim the range of things you're looking at, and that's very important, especially for gamma, which is concentrated at the nearest expiration. So your gamma values will always be highest at the nearest expiration. But things like delta, you may want to look a little further out to get a better, or vega especially, which is more concentrated further out on the chain. At later expirations, you'll want to get a better view of those by adding additional expirations into the range you're looking at. And one of the first things we always get asked about this is why can I not look at one expiration in the future by itself? And the reason we chose to do that with this tool is because we want you to look at all of the aggregate exposure up until the date that you've delineated. And so if you've picked the April OPEX expiration, which I believe is what is that, the 17th, we want to make sure that you are taking into account all of the contracts that are going to be expiring up until that expiration, and not looking at that expiration floating alone by itself, because it is important that you add the cumulative value moving forward from the current point in time at which you're at. And then get that view. If you guys wanna start, I think that covers pretty much everything. There's a few other features. You'll notice that the range of strikes that you can look at, especially on something like SPX, where you have lots and lots of strikes, is a little bit limited. You can actually back that out, and you can look at all of the strikes if you want to. Sometimes that breaks a little when you zoom out too much. But we do have some fixes for that as well. Oh, okay. That's how I forgot. That's how you fix it. You literally just change the literally just change the thing. Right now, we'll get some scaling parameters reset on that to get that fixed, but you can zoom out and kind of look at the broader chain if you want to look at really far out of the money strikes. But we do have it kind of centered around wherever spot is. That white line there is where spot is at market close, and then you have this line here, which is kind of showing you, I believe, is that gamma neutral?
I think that's the flip point.
Oh, okay.
But it might just be the neutral.
I think it's gamma neutral, yeah.
Yeah.
Is it? I'm going to double check that.
Spot check it. Let's go.
65, 69. No, it's not. But it's like maybe the nearest strike to gamma neutral. But
yeah,
also not. Yeah, I guess it's the nearest strike. I think it might just be gamma neutral.
Yeah.
We just throw shit onto these tools as we see them interesting too. So Part of how we iterate.
Yeah, so maybe we should spend some time talking about what all this data means.
Yeah, I agree.
No. Hard
Huh.
disagree. You're right. Let's do it.
Here's a bunch of data, guys. You can have it or you can't.
Yeah, do you want to cover what each of the things are, or you want me to do it? I mean, dealer's choice.
We provide numbers. Some number big, some number small, some number up, some number down. The numbers are all arranged left and right. Yeah,
I love
so as far as what all of these Greeks tell you, I know we talked a little bit about it last time, but it probably isn't a bad time to go through some things a few times, because this data is very important for options traders. Why is it very important? Because it gives you a sense of what other people are positioning for, what outcomes they're positioning for. And as we talked about a little bit last time, and as you'll hear us talk about a lot, the most valuable information in the market is understanding what other people's positions are. You know, it's like knowing what, your chess opponent, what move they want to make next before they make it. And so how does all of this data start to tell you some of those things? Well, the simplest one is OI and volume. So OI just tells you how many contracts are open for each option on the chain, and where it's open at. And the volume tells you how much has been traded that day, obviously. And so that just by itself gives you a sense of where is most of the positioning. So this gives you some sense of positioning by strike and also by time with the slider that gherk showed before. And okay, so that's easy stuff. What contracts are open, what contracts are being traded, and where. Then we get into the Greeks: delta, gamma, vega, charm, speed, vana. There are more Greeks than this, but they become less and less important as you go farther down the list. They become round-offs pretty quickly. Nevertheless, we start with delta. It is the most important Greek, I would say. I mean, I guess it's up for debate depending on what your strategy is, but for someone like a market maker who doesn't want to have long short exposure, they're going to want to make sure that they are delta hedged, which means that, for example, if I buy a call from a market maker, it means they are short that call. And if that call has 0.5 delta, and that means the market maker short 0.5 delta or short 50 contracts, because that X, the pricing is the X, the delta is the X, basically the expectation of the probability that the contract is going to end in the money. So 50 delta is roughly a coin flip. So you better, probably on average over many contracts, over many chains, you want to make sure that you have the ability to meet your assignments at expiry. And so you do that by making sure that you own the delta that you have to deliver. So if you're short 50 if you're short 50 shares of something because you sold a call, then when that call comes due, right, your expectation is that you're going to have to deliver 50 shares, right?
At that exact point in time, yes.
Yeah, and so the way that you hedge that risk is you buy 50 shares. And so me buying a call from a market maker causes the market maker to buy those 50 shares of the underlying, which causes the price of the underlying to rise. And this is the basic mechanism for how options drive price in the markets. And the volume, because of the leverage, the volumes traded, this is substantial enough that it is driving a good percent, if not most, of the non-high frequency trading volume in the market today. I mean, the options trading is so ubiquitous, especially among big hedge funds and big players, that insurance funds, things like that. It's super important. So basically, buying calls causes the market maker to buy stock. Selling puts also causes the market maker to buy stock, right? Because if you are selling a put, that means the market maker has to buy the put from you, which means they have a negative 0.5, negative 0.5 delta that they have to hedge by buying. So the delta effect of bought calls and sold puts are both bullish, and then the opposite is true. If I sell a call or if I buy a put, then the effect on hedging, the effect on price in the market is negative. So it kind of matches what you want out of the contract, right? So if you expect price to go up, then you either buy a call or sell a put or both, right? And that will actually cause, market pressure to achieve the thing that you wish to happen, right? And vice versa. So that's the easiest way to remember delta hedging if you get flipped around on the negatives and positives. If it's a bullish position, the market maker's buying. If it's a bearish position, the market maker's selling. Did I miss anything on that? I think that's
That sounds like
pretty
delta in a
complete.
nutshell. Yeah, I think you're good.
Yeah. I mean, it's it's where and when you're looking at it by strike, I guess I should add, it's telling you a lot about the directional and hedging importance of that strike.
Yeah, and so we talked about, okay, well, when I buy a 50 delta call from a market maker, sure, it's 50%, but at expiry, all contracts either end up 100 delta or 0. They either are in the money or not. And so the delta, or the roughly the probability that a contract will end in the money, is constantly changing. And it changes due to changes in underlying stock price. Obviously, if you own an out of the money call and the price starts going up, your delta is going to increase on that call because the probability it's going to go in the money starts going up. It can change from a change in IV, which is basically an expectation of future variance or future volatility in the market. So, and well, I'll get to that in a minute. And it can also change with respect to time, right? Naturally, it must expire as either a delta of 100 or a delta of 0. So over time it will evolve to either one or the other of those. So changes in price, changes in IV, and changes in time. Those are the three primary ways that delta changes. Those are measured by the Greeks gamma, charm, and vana. So gamma measures how much delta changes with a change in price. Charm shows you how much delta is going to change over time. And vana is going to show you how much delta is going to change with a change in IV. Now, it's probably worthwhile to take a note of the y-axis units that we have chosen to display these values in. So if you go back to delta really quick. So delta is in dollar values. So this basically tells you how much buying or selling pressure those contracts are exerting on the market. So for example, the contracts I can't see that, but it's 65. Contracts is 6,500, I think is what it is. The net delta on those contracts is, a little under negative 8 billion, weighing on the market. So that's selling pressure.
Negative 7.6.
Yeah.
Yep.
Yeah. So that tells you, that gives you a sense of what is the effect that it has on the market. So you can think about, okay, how much is the stock trading at? If you're Apple, it's trading around 250, and if it trades I'm pulling a number out of my ass, but 100 or let's say 1 million shares a day, whatever. That means that 200 shares, dollars worth of shares were traded that day, right? And so you can kind of gauge, you know, I think a good point of reference is the markets trade more or less like $50 billion a day in shares and other instruments. That doesn't include futures. I think futures are much larger, but at least for stocks, it's something like 50 billion a day. So you see like negative 8 billion in one strike. That's pretty big, right? That's pretty meaningful. If somebody were to open a position that big all at once, the market would go insane. Like there'd just be a massive candle. It would be chaos. So then if you go to gamma, so let's look at the units on gamma, which is the change in delta with change in spot price. So this is dollar per percent of spot. So this basically tells you how much is the market maker going to have to buy or sell if the underlying stock moves by 1%. So you can see, okay, if SPXW drops by 1% overnight, the market maker has to buy, for that 6,500 strike, the market maker has to sell a little over $2 billion. So that gives you another sense of, how sensitive these contracts are to changes in price. If you then go to Vana, let's do that one next. You'll notice that is delta dollars per IV percent. So this basically tells you how much buying or selling has to happen if IV changes up or down by 1. And then finally, we can look at charm. Ooh, you're getting fancy.
You're just showing
here.
the Vana titties, yeah.
So if we look at charm, and maybe this one always kind of gets people. Yeah, if we could show the calls and puts together. So remember I said the contract has to either decay to 1 or 0. So we do refer to it as decaying. And so a lot of times people will call charm delta decay, or how it evolves over time. And whether it goes to 0 or whether it goes to 1 depends on if it's in the money or if it's out of the money. So calls are obviously, the calls above spot are out of the money, and the calls below spot are in the money. And so they're going to decay in opposite signs. And you see all the calls below spot are positive and all the calls above spot are negative. And again, if you look at the y-axis, we demonstrate this in dollars per day. So this is a way to kind of get a sense of how much is the market maker buying or selling just because of the passage of time. And so you can see these numbers are somewhat lower, that we're not in the billions anymore, but we're still in the hundreds of millions. So it's not nothing. And of course, this is SPXW and everybody's loading up, it's a very heavy chain.
Especially right now.
Yeah. So those are the kinds of, like, those can tell you, okay, what is the size of the hedge that actually is sitting on the market, and how is that hedge going to evolve over these 3 different pathways. And so you can kind of get a sense of sort of where's the pressure and things like that. The only one, let's see, so the 2 we haven't talked about are Vega and Speed. I think maybe I'll just talk about Speed really quickly, just to kind of get that out of the way. So one of the things you'll notice, and maybe we could talk about the live version of this page too, I don't know, later on. But one of the things you'll notice is that gamma will also change as you move towards or away from a strike. So, for example, well, I don't have an example because I don't want to pull it up. But basically, if you look at the speed here, the speed tells you how much is that gamma going to change with a change in price. So it can give you a sense of, okay, well, there's a lot of OI. Let's say there's a ton of OI out at 6,500. Actually, this kind of works great. Maybe can you pop over to OI again really quickly? Yeah, so there's a ton of put OI at 6,500. There's also a ton of put OI at 6,400. So let's just remember those numbers. There's, like 60,000 each in each of them. Now go to the gamma. Oop. So you can see that, even though the OI is about the same for each of those strikes, the gamma is lower at 6,400. Now that doesn't just mean it's always, that doesn't mean that somehow those options are inferior to the ones at 6,500. It just means that we're farther away from that. So the change in price, or the probability that'll go in the money, is less sensitive to price. Okay. But as we move towards it, it will start to become more sensitive to price. And so its gamma will increase. And the gamma will increase for both of them. And you can get a sense of, okay, how much is gamma going to increase as price moves by looking at speed. So now if we finally go to speed and focusing again on those two strikes, the amount of dollars that it will increase per spot, right? So this is basically how much the market maker is going to have to buy based on the speed, shows up here. And you can see that these are still, fairly significant values, hundreds of millions of dollars. This is mostly because the OI is huge. So so there's a lot of gamma there relative to the delta. And as you move to it, there's a lot of change in gamma, which causes a large hedging effect. And so what tends to happen is because human beings like round numbers, it's one of the 3 fatal flaws of human beings. One is we over anticipate what randomness is. So we think that if you flip heads, you're more likely to flip tails next. That is one of our flaws. Another one of our flaws is that we like round numbers. And that shows up in options chains everywhere, where people are picking, nice round numbers of 100 or in some cases 10, depending on the size of the chain. And oh goodness, I've forgotten what my third flaw is, but I'll remember it. I have 3, but I just remember 2. But anyway, you'll notice that because options are concentrated around specific strikes, you tend to have interesting mechanics and dynamics that occur around those strikes. And maybe gherk wants to go through some of that stuff because he focuses a lot on the relationship between those important strikes and how price tends to change throughout the day.
Yes. Yeah, we can. Well, okay. Yeah, we can. I guess we can start with doing that. So generally, as far as gamma goes, I'm always going to be looking at gamma in the shorter dated ranges, 0 to 5 DTE. from the current expiration. So the 0 day is most likely what I'm trading the most, but I will look at gamma across all of the expirations to get an idea of like kind of regime that we're in. And the first thing I always want to look at is I want to look at where is spot relative to gamma neutral. So without breaking this all out and trying to find where the market maker's exposure to gamma is 0, I have it drawn here for me in a nice little line that I clearly asked Nuke to put in and not label. And if spot is above that line, well, we talked about this last time. We talked about the two gamma regimes, and you have negative gamma, which is a volatility increasing regime. So volatility goes up and variance goes up. So this leads to more realized volatility, and generally more realized volatility leads to more implied volatility. And this is because the market makers, or the dealers, let's say dealers, sell the downtick and they buy the uptick. I'm going to cover this a lot because it's so important, and probably in full every time this comes up. And what this does is it causes wider movements in price because the market makers are always chasing spot. So wherever spot moves, the market makers have to then hedge in that direction. And so that leads to wider trading ranges throughout the trading day. And it also leads, to increased implied volatility, and increased implied volatility, especially on indexes, drives indexes downward. In a positive gamma environment, you get the opposite of this. Volatility goes down, and variance goes down because the dealer buys the downtick and they sell the uptick. So what this leads to is price action that is far more stable, generally trending in wider narrower ranges. So you have shallower price targets, and you have very stable price action that kind of climbs or drops slowly because the dealer is always working against whatever direction price is moving in. And so, the first thing I look at is where is spot relative to that. So we do have positive gamma. We are in a positive gamma environment right now. Spot is above the neutral point. So that tells us that there is some stability in price, which we saw today throughout the trading day. Is there was quite a lot of stability above the 65 level, which we can see here is where that neutral point currently is roughly. It's about 70, I guess. 69, I think, more accurately. And we were fairly stable above that. We held above it into close as well. And this means, going into market open on Monday, 3 days from now, while a lot of macro things could obviously take place, spot should be considered to be in a fairly stable environment. And now we want to look at the individual structure of gamma. As you can see, there's kind of a clearly defined slope from about 65.25 all the way out to about 66.05 at the top here. Now, spot is kind of here in the middle of these two bigger piles of gamma. And this kind of, each of these different structures kind of has a different effect on how spot will behave. So, because we have this higher gamma to the downside and higher gamma to the upside, As we approach these, the market maker will sell more. And the same thing down here. They will buy more. And so what happens is spot kind of gets stuck in a little loop here. And it kind of gets pinned at these strikes that have very low gamma, because it's easy for spot to move back and forth across these strikes that aren't very disruptive to the dealer's hedge. And for this reason, we kind of treat gamma like it's gravity. And this has been the easiest way for me to explain this, but big piles of gamma are both attractive, but resist price movement out above them into lower areas of gamma. So if spot is here, it will be attracted to this gamma. It will generally kind of pull into it, and then it will kind of orbit it. Now, if it falls back below it, price will fall as it escapes. If it pushes out above it, price will rise rapidly as it goes into the money, and the delta increase on those strikes. Delta starts to increase on those strikes as they add intrinsic value. But it and in such a way that big pile of gamma from the upside acts as support. From the downside, it acts as resistance. And when you're at it, it acts as a pin. And this, and then in negative gamma environments, things get a little bit different. Delta tends to slide because if you're thinking about a negative environment and the market maker selling into direction, then as each of those progressively larger piles of negative, I should draw them upside down, right? Progressively more negative piles of gamma go in the money, the dealer starts selling more and more. And so you get price action that kind of moves straight down the entire ramp to the strike that is lowest, where then support can be found and things can turn around. And so it's always going to be price being pulled to kind of like a black hole towards the most negative strike. And then if the strike below that is significantly less negative, then the dealer will sell less as this last strike goes in the money down that kind of ramp. And as price goes this way, the dealer will buy slightly more at each strike, and so price can move back out to the upside in a similar fashion that it went down. And so I think that gives people a rough idea of how kind of price behaves around different piles of gamma. But there's a lot more. I don't know if I could go through all of the different structures right now, but you will run into situations where you have very high gamma at one price, and price doesn't like to stay here. It likes to move out away from that large pile of gamma. Even though it does pin there as price kind of orbits it, dealers will seek to move away from that big pile of exposure. And so, sometimes that might mean that they encourage people to sell these options, or they encourage people to buy these puts vis-a-vis pricing. And those incentives occur naturally within the market anyway, just based on the way the dealer is hedging that higher pile of gamma that spot is stuck on. But yes, generally speaking, price will want to move to those levels. Sometimes you'll approach piles of gamma that kind of are flat. There's very little change in gamma as price moves through those levels. And so just much like, very low gamma, multiple strikes of very high gamma are also easy to continue pushing through. So if you're trading and, spot is here and you go long and spot climbs up and gets up to this strike, it's very likely that spot can continue out to that further strike as long as these stay relatively equal to each other. But it will run into resistance here where gamma falls off again. And that's just some of them. There's many more setups that can occur, but I think that gives a fairly good idea of how gamma affects the way price behaves. And that doesn't tell you bullish or bearish, but it does give you a very good if-then type of way of trading, where you're trading more of the regime and the positioning rather than trying to trade how you feel. And I think that is a far better way to trade, personally, because you can say things like where we're sitting right now, and we kind of described the higher gamma to the downside and higher gamma to the upside. We know that this is a very big resistance, especially even if we look all the way out on the chain in both directions, it's significantly large. And so you can do things like when spot tests here, sell calls, because you expect that to act as resistance. Now you can, confirm that that's wrong if you break above it. But it's more than likely that spot will get pushed back off of that as the dealer sells more on the upside moves, and the profit taking from the calls that are already profitable on that test pulls spot back down. Or you can play the breakout of that level, which is a bit more extreme, which would be like if spot goes over. So if spot greater than, and I want to touch on something here. So this is the 6605 strike. It's really if spot greater than like 660750, then go long, because the continuation for that price action leads to the next resistance, which is at 6650. And this is not maybe the higher probability play, but it is also inferred by the structure here, as being viable. And then
So
you can also
confirm confirmation levels almost.
Yeah, and that's because of the way dealers hedge relative to strikes. So if you think about a strike, the center point of that hedge is in the middle, the dead center of the strike. But at the dead center, not a lot's happening, right? The dealer is fully hedged. But as spot drifts to the upside of that strike, 660750, or to the downside of that strike at 660250, their hedge starts to change. And across those levels, their hedge changes very drastically. So it's kind of like as spot moves, the effect of the gamma at that strike starts to pick up momentum in the dealer hedging. And so this is why I always kind of confirm, if you guys watch my stream, I'll confirm at levels that are not the actual strike price. Because those levels are far more significant as far as directionality goes, because the weight of the strike in question is starting to push against spot as spot crosses that level slightly further away from the actual strike. And then you can also buy a put on that test. You can buy a put or buy an in the money put and expose yourself to the structural, event that is going to occur when that is tested. And that is that the dealer is going to stop kind of buying the underlying. So the dealer is going to stop, pushing up. They're going to start to sell a little right? They're going to, as that gamma increases, their exposure to that gamma increases, they're going to start selling against that uptick. And as they start selling against that uptick, it's going to shake out participants that are long. And those participants are going to take profit, which reduces the dealer's delta exposure kind of behind spot from in the money calls, selling to close. And that tends to cause spot to fall because then the dealer is going to sell more. And spot will, and people are they're gonna buy to close short puts, they're gonna sell to close long calls, and you get kind of a rejection. Now, whether that rejection holds or not, that's something we watch in live data where we see how people react in real time to those levels and what kind of positions they buy, and we'll do that at a later date in one of these roundtables. But you can buy a put that's in the money because you don't want to be, you're in a positive gamma environment, so you don't want to be targeting out of the money options because it's much better to trade the delta in an environment like this where realized volatility is declining. Whereas in an environment where realized volatility is rising, you want to trade the gamma. And so you could buy an in the money put here, wait for that slight rejection, set a stop, see if it continues. Because it could theoretically, continue all the way back down to the other support, where, then you may want to sell puts and buy calls. Because if support is found here, then price is probably going to go right back to the other level, to the upside. And it's going to kind of swing back and forth and back and forth. And that's how price moves throughout the day. But understanding how positioning affects those movements in price is very important to effectively trading those levels. And I think that's all I want to say on it. Maybe.
I mean, I think it should be clear to our viewers too that gherk is a day trader.
I am.
He's talking about a lot of this stuff in the context of a day trader for sure. I mean, especially with short-term moves, you notice he's looking at these short time frames. He's watching gamma because on the shortest time frames, especially on the S&P 500, there is an unbelievable amount of gamma near the money, especially as you get close to expiry. Every day is OPEX on the S&P 500. So that's a lot of where his focus is too. But you can use these Greeks too for longer dated positioning, things like that, trying to find out sort of where's the liquidity, where a contract's going to be, shaken out if something happens. Like if IV changes on, this stock that I'm looking at, maybe you want to look at Vana, right? Or Charm to try to figure out where you can position or plan to position based on how the market is going to react to certain things and kind of plan your own chess move on the chessboard. So for me, I like to look at delta for that personally. And that just gives you an idea of, I like to take a more holistic approach and just see on OI and delta, what's the difference between them, right? Where are all the contracts concentrated and where's all the delta concentrated? And you can kind of see, okay, this is spots where I would assume that market participants are going to be a little more sensitive to, outsized changes in price. And because of that, they may change their positioning in an outsized way. And so, maybe I'm interested in stock X. And I see that there's a decent amount of OI at a strike, but there's a ton of delta at that strike, delta exposure. So maybe what I'll do is I'll watch that strike, I'll watch that stock, and if the opportunity strikes, like let's say I want to buy stock in a company, I'll see it maybe move down a couple percent. I'll see that contract, the price of that contract move in an outsized way, and then I can jump in on that contract with a decent entry price. So that's something that I use for longer dated and not necessarily options related positioning, because you can also just use these tools to kind of find out, like Gherk was saying with support and resistance on gamma. On longer time frames, you can suss out where there's going to be a lot of support. You can use those as your sort of signals to potentially consider entering a part of your position in a stock. So that's one of the ways that I've used it in the past, and I do use it now. I actually have a couple stocks I'm watching where I'm watching the delta and the gamma to see, oh, these strikes are what people are interested in. And so either they're going to react or they're going to double down when they get there, and then I can move accordingly and, buy some shares and build my own little position on things.
Yeah, I mean, I want to say yes. I do use this for day trading, but it also affects longer term positions, and especially managing longer term positions. Once you're already in them, you have a price target in mind, a level. It's important to remember that the near term fluctuations in price are going to be dictated heavily by gamma. And so, if you have risk levels or take profit levels, understanding how these gamma regimes affect price action is still very important. Both for, whether you're selling options, you're buying options, they're short dated or long dated, it doesn't matter. These are important things to understand. I kind of just want to add that.
Yeah, absolutely. Yeah, no, that there's a decent amount that goes into these. I mean, really though, like JFresh said in the beginning, and as you just demonstrated throughout, I mean, delta and gamma and charm are kind of the bread and butter of this page in terms of where you're going to glean the most information about how the market maker is positioned, will position, and how the market is positioned and potentially will position.
Yeah, I'll add one more little nugget as well, because once you open or close a contract, right, that changes the delta which the market maker hedges, but then that contract, that delta is not really it doesn't really change again, right? It changes because of the gamma and the charm and the vana, but that bulk there is just sitting, it's already been traded, right? That bulk delta part, that original delta part's already been traded. So what this stuff isn't showing you that could still potentially happen is that a change in realized price of the underlying could cause people to either open more contracts or close contracts that they have, right? And that's a dramatic change in delta that there is no indicator for, right? You just kind of have to get a sense of, why did participants open these particular contracts, and what would it take for them to close them? One example is sold calls on the index. So a common strategy for long positions is to sell calls against your long position, covered calls, to reap cash flow without having to sell the underlying. And there are cases where if you get too far into those, you'll cause them to close those positions, but a lot of times they're part of managed funds and things, and they just open them and leave them, right? And it basically just acts as a cap on returns, which they don't care, because as long as they're getting some return, that's all they care about. So nothing will cause them to close it. And so one thing you can get a sense of is that whenever the market is turning back around and starting to go up, you can very easily find calls that are actually underpriced farther out, just because everybody's systematically selling them. So those are some of the things you can think about, thinking about like the behavior of opening and closing these contracts to begin with, and what's going to cause different participants to make those decisions, and how you can position around it. Because I know that, like, for the last 2 years, out of the money call, couple month out, half a year out, call prices were just criminally undervalued, and they paid out for a lot of people for a long time. Obviously, this is not a great time to be thinking about that, as we're way below trend, but the bullish trend. But if we get back to a regime where we're just kind of gliding upwards, there's plenty of situations where those calls will be cheap, and that's the reason why.
Yeah. I think that's that's like the the other side of what I was talking about too. Yeah, the systematic funds that are going through and just, scraping off the bits of return that they can get from whatever stock or index it may be. They do end up creating these price imbalances that you can't take advantage of for sure. Absolutely true. Well, should we hit the by expiry? I mean, the expiry one is fairly straightforward. It's the same things we talked about, but you can look at things by expiry and get an idea of, okay, especially with SPXW, which is our short-term SPX option chain, you can get an idea for sort of how the hedges are going to change over time, what's going to fall off tomorrow, well, what's going to fall off the next trading day and the next and the next, and they'll change over time, a lot of them. So I think they're most useful to use with OI personally, but you can use them with any of our Greeks and kind of see, okay, what's gamma looking like for the next day's expiry or delta. And depending, I mean, for trading strategies that are more time dependent, that's going to be more relevant for you versus price dependent. So this would be your delta neutral strategies. You may be looking more at the by expiration configuration, I guess we'll call it. And in that configuration, the slider on the right doesn't really do much besides shorten it. So, you may as well just zoom all the way out. So, yeah. And then, yeah, personally, I look a lot at delta, gamma, a little bit of Vana too. If I'm feeling especially degenerate and I have a little bit of money to burn, Vana by strike is an interesting one to look at because you can position yourself once again to sort of get an idea of where these funds may end up rebalancing in the event where a stock, the behavior of a stock or the outlook of a stock or an index changes. You can use that to position yourself to take advantage of that. So I enjoy that one as well. But yeah. Should we move on to
You
questions?
want to push the button, the strike? We never pushed the strike button.
I can't. I'm not in control of the screen. I'm not the screen man. I'm not the back of house. Is that Ron?
Gherk, push the button.
I think he's busy making himself an espresso.
Ugh.
Which is a euphemism for squeezing the lemon.
He did just say carry shit for a minute. I am away from keyboard, and I didn't read that. Okay.
Way to break the fourth wall, Jay Fresh.
we can't push the button on his behalf. But
all right, what do you need me to do?
Push the button.
He's back. Push
Which
the
one?
strike button.
Ah,
We never showed him. Yeah. Ooh, God.
Ah!
I had it on 0DT.
Yeah, that's what I was saying that earlier. Like sliding the expiry on the expiry configuration is kind of, all it does is really zoom in. But it's a good way to look at things if you have time sensitive positions versus price sensitive positions.
Yeah, so you can see even from the gamma, even though gamma should decrease as you go farther out, where like massive positioning is located, right? So you see the exponential drop off, it's short dated, and then there's just the massive candle on April OPEX, and then there's end of month April, and then this massive one for end of year 12/31.
Yeah. So this is something that I find more, I mean, it's fun to like, I find it more as a curiosity for SPXW personally, because I don't do anything time dependent on SPXW, but for individual equities, you can actually come up with some decent sort of, time frames for certain positions you want to take. Like, let me see what Microsoft is doing on
All right,
here.
Ron. We got questions.
We've got a bunch of questions.
Where are they at? Where's the list?
I'll tag you.
Yeah.
Oh, he tagged you
Woo-hoo.
first, damn it. We have a question 0. What the why are you indexing at 0, Ron? This isn't fucking C code.
Wait, doesn't Python index to 0 too, and JavaScript?
I don't know and I don't care. They probably
what
do.
indexes to 1 besides MATLAB?
Lua.
Oh.
What's
All
funny
right.
is
Well,
even in the embedded platforms. Go ahead.
You're the question MC, so you read the questions.
Okay. So let's see. Let me see this first one. That's definitely a Volstars question. That's question 0. Let's move to, let's see. That one is, okay, release. Okay, I mean, we can hit question 1. I think this is
Just
related.
okay.
I'm trying to get more use out of live Greek by strike as it relates to IV intraday. Sometimes I'll hear gherk refer to IV popping under a certain level, and I'm trying to better ascertain when that is more or less likely to happen on a given day.
Hmm.
When I think
Okay.
of questions like that, it jumps me straight to Vana personally.
I want to say, yeah. When I'm saying that, I'm just talking about the live IV smile. I'm not referencing Greeks by Strike at all. I mean, you could go look at Greeks by Strike and look at the strike I describe, which is what I will almost always do. I'll be like, ooh, IV at XXXX strike is kind of popping off. And you could go look at the Greek by like the strike that I'm discussing. But if it's out of the money, you're not going to see a lot of big changes in like gamma or delta at that strike on the live data. You might see some changes in Vana, but I would say that's more about a different tool.
Yeah, we'll hit that in the live data one. Okay. Question number 2. Why wouldn't price action just move to the big bars, assuming calls are bought and puts are sold? More positioning equals more gamma, and as price moves, more delta is bought or sold and would increase that move. It kind of does.
Yeah, it does. I kind of described how those, if you go back a little bit in this, I kind of described how those big bars of gamma act as sort of gravity wells, or like, I like to think of them as like different sized planets in a solar system and trying to navigate them in my little spaceship.
Yeah, I think that's like it is kind of like, you know, as you pass by them, you kind of slingshot around a bit, and you know, depending on whether or not you get the the escape velocity or not, depends on how much energy is put into it. I think that makes sense.
Yeah. Yeah, if you don't get
So-
enough escape velocity to get away from the strike you were at, where you started, you're going to go back to it because you're not
Yeah.
breaking away from the orbit of that strike.
A little more chaotic, but it's a decent enough analogy that I think it works out pretty good. So question 3.
Well, hold on. One thing I will
What?
mention, they did say, assuming calls are bought and puts are sold, that's backwards.
Oh, right. Yeah. Calls are sold and puts are bought. You have to assume that everybody's buying insurance or setting up some sort of insurance on their long stock position.
Yeah, and reaping cash flow. I mean, that's the naive assumption.
Exactly. So thank you, JFresh.
And the reality on indexes is that all puts are sold and all calls are sold.
Yeah, at least for the short dated stuff. Yes, right
Yeah.
now that is true. On zero DTs, it's absolutely true. Almost always, it's insane.
Yeah. No. Well, and we can get into the 0 DTE short vol trade. I mean, we've hearkened on it and just absolutely beaten that horse to death several times over, and now we're just like whipping a skeleton. over that, but
Oh.
we can cover that in Vol Stars. It's definitely an
Don't kink
interesting
shame.
topic. Question 3. What time does Greeks by Strike refresh in the morning?
Asked and
6:30
answered.
a.m.? Okay.
7 a.m. Well, by
7 a.m.
it definitely by 7 a.m. But
Yeah,
could
it
be
takes some
sooner.
time to crunch the numbers.
And
Okay.
sometimes, unfortunately, the exchanges just don't send it out in time. Like, it just is delayed a lot, and it's just really annoying.
Yeah, we're kind of at the mercy of our data. Question 4. Gurgis talked about selling naked call. Oh wait, this is a Greeks question. Do we do a Greeks question? What do you guys
We
think?
are talking about Greeks by Strike, so maybe.
I mean, this is purely Greeks. There's no Greeks by Strike in it at all.
Do it. That's fine. Sure, it's
All right,
not hard
Gurgis
to
talk
answer.
about Gherk
Give the people what they
talked
want.
about selling calls over Gammamax on the monthly. I'm assuming he's talking for SPX. So
Yeah.
Gherk's talked about selling naked calls over Gammamax on SPX in our ticker list. Is it ever worth the risk to sell shorter dated calls over Gammamax on the weekly, which is SPXW in our ticker list?
I mean, right now we're so far from Gamma Max, it doesn't matter. Really, I mean, the chances of us slamming into Gamma Max or on SPXW are extremely thin, and you would have
Have you
plenty
considered Taco?
even then. And yeah, Trump's been tacoing for weeks to no avail. We've won this war more times than any other war we've ever won in history, while still continuing to somehow be embroiled in it.
Yeah, I think there's no untacoing this taco, but we have a follow-up, by the way, to the we have a follow-up to question 2. They're asking why do we assume the opposite, right? Why do we assume that calls are sold and puts are bought? Well, I think I can just touch on this really quick. In a conventional portfolio, when you have a positive exposure to a stock, let's just say you own 1,000 shares of Apple, right? Let's just say that Apple is not going up as much as the S&P 500. What are you going to do to make sure that 1,000 shares of Apple's kind of catches back up a little bit, at least in your portfolio? Is you're going to try to collect some sort of premium on the shares you own. And not only that, but you may try to collect premium with the cash you have on hand. And so that way, let's say SPX is at a 5% annualized return, trajectory, and you're at like a 3%, you may want to make up that 2% by selling calls or you may want to also buy puts to make sure that you don't get caught if Apple goes down a bunch too. So those are the two most conventional things. People want to not lose money, and they want to try to collect some premium on things that are not quite making them money as fast as they should.
Dork, I'm gonna throw you a curveball here.
Oh God.
I want to see if you memorized my pitch. Why do we use the naive assumption? A lot of our competitors are claiming that they have bought and sold. So why naive?
Well, I mean, the biggest reason why is that if they're claiming to have that, I mean, unless they're actually market makers, they have some sort of derivative of that, right? So you end up with this derived, potentially inaccurate view of the market, and when you look at it from a naive assumption, you end up with a upper bound to the market maker hedge, right? So that makes it a lot more reliable in terms of being and it's an extreme case, right? Because it is naive, right? So that's true, but it does give you a good overview of the net positioning. When you consider the mentality of the conventional investor, it tends to shake out all the same. Did I get it?
Sort of. So as many of you guys who follow along every day know, we do have our own, version of bot sold in-house internally that we've built. And sometimes, I'll share that with you guys on stream. We have some tools coming out soon that are going to be using that in a way that you guys can follow along with for Gammastrike. But we had a lot of back and forth on Nave.
So much back and forth.
So much. Because, it's a great marketing tool to say, oh, we can tell you if X is bought or Y is sold and which direction all the trades are going in. And the reality of that is nobody can truly do that. The only two ways are you have to have you have to build a model, like a model, a model that makes assumptions and is also, not transparent, because if you really could figure it out perfectly, you would obviously make tons of money. So you have to keep your model a secret, which means you can never tell anyone how it works. And then use that model, or you can get a CBOE publishes a report for market makers to hedge off their tails, and they publish it. I think it's every 10 minutes. It's wildly expensive, and
they do also sell a 1-minute version, and it's even more egregiously expensive.
Of course it is.
I don't think any of our competitors use the 1 minute.
No, I don't think so.
I don't think their cloud services that they've built could even handle it. I think they just explode.
Probably. That's quite a lot of information to pull in and calculate in a minute. However,
the quad isn't just there yet.
However, the problem with that is it's always historic. So you're always looking at what happened in the past in a market that is constantly evolving and shifting. I think today's $100 move in 2 candles tells you everything you need to know about how important timeliness is. And so we ultimately chose the Nave model for the product because it is consistent, it is robust, and it is falsifiable. It can be tested. And so, the Nave assumption, while simplistic in its, in how it is derived, makes a clear claim that does not change, and that invites measurement. And if you're a trader, 99% of your time is, if you're serious about it, should be taken up testing. You are testing, what does this do? How does this work? Can I do this and get X outcome if I do this every single day or every time it happens? Will the outcome be consistent? And what are my probable returns on this? And that is not something that you can test with a model that you do not understand, that you have no insight into. You don't know who built it or if it's even accurate, and it is not consistent. And in order to trade, you need to be able to rely on your data being consistent so that you can build trades around the consistency of that data. So the Nave assumption gave us all of that. It gave us consistency within the model to allow our users to hypothesize, observe, and iterate.
I think that's yeah. That's a perfect synopsis of it. I think I danced around it and you just smacked it with a hammer.
Yeah, I'll just add, talking about the tools we've developed, we've watched them for a long time to kind of get a sense of what they are accurately telling you and what they aren't. And we've decided that the best way to start to implement some of those things is to use it as a rough, qualitative indicator that is in addition to all of the other things. So instead of people getting dragged into, what we want to avoid is people looking at something and saying like, oh, this contract is 62.5% sold. because nobody knows that except for people who, pay for the full bought sold time and sales from the market maker stuff on SPXW, which is almost all of the SPXW, but not quite all of it, but it's enough. You can get
Yeah,
it
it
for other
leaves
stocks as
it
well, but it's
actually.
such a small percentage of the actual trades that it's worthless. So people only really have this for SPXW. Otherwise, they're using a model just like we are, but they're presenting it such that it gives the illusion or the implication that it is a quantitatively accurate calculation. Is not. So we do think that there are trends and loose positioning strategies that we can observe from it that are useful, and we just have to display it in a way that that gives that kind of hints at things and doesn't just say like, hard numbers for anything, because they're not accurate, but they are accurate in trend, like kind of in aggregate.
Yeah,
Yeah,
I
and I
do.
mean,
Yeah, when people say bought and sold, it's definitely for me. It's hard for me to trust that because the market is so full of people who are doing OTC trades, and you don't know if someone just went and bought 1,000 calls and got filled at the bid, right? You don't know.
yeah, you have a lot of problems even with the SIBO report, and that it is a partial tape. You have multi-leg attribution that's not necessarily covered. You have internalization that occurs constantly, and you have OTC. You have swap markets. You have futures, which is a totally different market. That is where the fundamental, all of the delta for the delta hedging on SPX is purchased in a totally different market. And so yeah, I mean, it just doesn't really lend to any significant benefit in my mind, at least.
Yeah, I will add too. I've compared the kinds of things that we do, which we actually are doing things to the data that other people are not, and would probably think that we were insane if we're doing it, but it makes a lot of sense for other reasons. But I've compared what we show to what these other people are showing in terms of bought sold, and honestly, I feel like ours is more actionable, even though it's not as quantitative. Because what it's telling us is that, are people more bullish here than they were before? Where are they? Where are they bearish? Where are they short gamma? Where are they long gamma? In a general sense, not in like a, right to the numbers. So you'll look at these other services and you look at the bars and it's just like one strike, it's like super bullish, super bought. And then the very next strike, it's like super sold. And then the next strike, it's super bought. And it just looks like nothing. And yeah, it doesn't really tell you much of anything, in my opinion.
Yeah, we've this feature that JFresh is talking about, we spent probably like actively every day, like probably 15 times a day spot checking it. I mean, it's some good stuff, and we're so excited to watch it get released because it's beautiful, because we are doing the right thing with the data, which is using it as a we're not like trying to say anything necessarily about individual strikes or what people are doing specifically per se. We're trying to make inferences about the market on the whole instead. So I'm excited for it. Okay, well, so I think we've covered selling naked calls over monthly SPX and over weekly SPX. Question 5. This one's more about the Greeks. The neutral positioning is fucky right now, and SPX is over VN on the weekly, which is Vega neutral, and GN on the weekly, which is gamma neutral. DN on the weekly, which is delta neutral, is above GN on the weekly, which is gamma neutral. Is there a scenario we stay above Vega neutral on the weekly for a month like last summer, or did that happen mostly because of Captain Condor? First off, Captain Condor was
not moving the
I don't think
market.
this. Yeah,
Quite the
he was
opposite,
kind of dropping the
actually.
bucket.
Yeah.
So whole idea is just that the neutrals are all kinds of weird right now, and I can understand the intrigue in it, because we are in sort of and as much as we've heard it throughout the last 6 years, we're in unprecedented times. We just basically saw the largest, tiny little hole of water that all the oil went through just basically shut down. And we really have no idea how it's going to look going forward when it opens back up. And so
Or if
that
it ever
affects
does.
right, yeah. And that if but the thing is, and so here's where things get interesting, because what we're really looking at, we're not necessarily looking at like, oh, the price changed, right? What really happened is that the outlook on the global market just shifted. Right? So if you imagine people playing odds, right? The odds just changed for everything. The amount of possible results of this just expanded by a lot. And so to see strange movements in these neutrals, I would say is not necessarily unexpected. In terms of trading above Vega neutral, I think it's possible, because Vega neutral operates under those assumptions we just spent so much time talking about.
Yeah, this is I mean, trading above Vega neutral is difficult and requires a fairly significant amount of supportive gamma, because the returns for the dealers above VN are concave versus convex.
Yeah, this is what this comes down to. This would be like the taco to end all tacos. Would and if there is big taco and logma going on, then we will probably see something like that happen as people rush in to try to get long exposure to not miss out on the upside to a resolution in this that may be favorable for global financial markets.
Yeah,
So it's
and
possible.
the period people are talking about, the other neutrals were far more stable. You had lots of supportive gamma and supportive delta, where spot was trading, and spot never traded very far above VN. Like, let's also try to remember that, as we mostly traded at VN, constantly mean reverting back to it as VN also increased over time. So as people took longer dated positioning on the chain, and as the chain rebuilt following, the April lows, we did have a period of time where we traded, a lot of our days above Vega neutral, but many of those days we also traded below Vega neutral. We traded at Vega neutral, we closed under it, some days we closed above it, but it was the one thing that was consistent during that period is that gamma neutral, delta neutral, Vega neutral, and gamma max all continued to rise together as the entire chain repositioned following what was effectively a market crash. And these are the only times you generally see the market trade for long periods above Vega neutral. Is when you're
It's
coming,
the same result. Like
yeah,
people
you're
are
coming
rushing
out
in to
of
try to get long exposure.
yeah, you're coming out of a recovery from very low price levels. Now we are coming out of one right now, and Vega neutral is starting to trend up. So, we are getting some of that vol shorting. We're getting some of that longer dated exposure to the upside that's increasing, where dealers are exposed to Vega, surrounding spot. But we're definitely not in any kind of like significant reversal trend just yet. I would say that if we get the supportive delta and gamma under us, then and Vega neutral continues to rise over time, then sure. I could see that. I could see that showing us that we are in fact seeing a reversal from these lows, and we're going to move back to, the levels we were trading at back in, February. But if Vega neutral doesn't continue to trend up, if the neutrals kind of flatten out here, this could just be, resistance, and then the market could continue to bleed out to the downside.
Or just consolidate too. I mean,
yeah,
we could just be reaching a price level where everybody's just starting to play musical chairs for a bit with their positions. JFresh, you got anything to add to that, or should I move on to question number 6?
Go ahead.
Okay, question number 6. If you guys, so if we could do a few examples, maybe how we interpret delta gamma vana for some charts like Apple. I like Apple. Why don't we just look at Apple really quick and just do a delta gamma vana, just real quick cursory glance and see what we got going on there. And just I think a good idea would be to just give a quick like breakdown of, oh, we see this, we see that, this is what's going on, this is what I think.
Yeah, I can run through that. I mean, I don't use Vana a lot overnight, but we could talk about it. I mean, this is an equity, so remember, if price is rising on an equity, IV is going up. Kind of the opposite of an index, where if IV is going up, the index is going down. So these are those are the equity up, IV up on that equity. So if we look at the full chain here, you can see that it's in a positive gamma environment. So we know that spot is in a positive gamma environment. We see that there's a fairly large pile of delta here at 240. There's another fairly large negative pile down at like 245, and another pretty big one at 250. These are all going to be kind of supportive. This is like kind of a supportive structure to the downside, but 250 quickly gives way due to the negative gamma at 245 to 240. So if spot were to fall under 250, it's very likely to move to 240. To the upside, there's resistance at 260. A breakout from that price action can kind of carry out to like 270, where it gets a little bit choppier out to the upside, where major resistance is at 280. Under 250, there's very little delta, and price can kind of hurtle down to like 220. And then it gets a little bit more supported into the test at 200. And so that's kind of what I can see here on the delta page. If we go to gamma, we can see that spot hasn't quite crossed up into the level where things are bullish, and so spot is at resistance here. Spot can fairly easily fall back to 245, where there's a little bit of support, and then you would get that further move down beyond that towards 230. So remember, these are the nearer dated effective options. If spot continues to climb up, it needs to get out above 260, but out above 260, it's got pretty easy continuation out to like 275, 280, where you get this little dip. This kind of tends to trap price. Remember what I said earlier in the night about these gamma levels kind of trapping price because the dealer pushes back against the breakouts, and then major resistance here at 280 on the gamma side, and then 300 out above that. So very unlikely to get to the upside of 280. If it continues to push up above 260, like I would say like 278 is a possible target there. And you'll notice I'm kind of ignoring the gamma in between these strikes. And that's because once you have like momentum from crossing this major strike, it tends to like float, right? So if you think about all of these in aggregate and how they would look, your dips wouldn't be as extreme as they appear here. And so price can kind of just ride along those, because the major strikes are relatively high, even though the kind of in between like offset strikes are not. And then Vana on this, I mean, obviously it's going to pick up some IV if it pushes up above spot. Delta starts to be more significantly affected by IV above 260, which is, what we already saw out on the Gamma page and a little bit on the Delta page. And so that as IV rises, that helps continuation out to that 280 level. So, the Delta indicated about 300 as the upside resistance. Gamma and Vana indicate about 280. So 280 is probably where upside resistance is. That's on a break of 260. And then I'm just kind of putting these all together in my head. And then, if it fails to the downside and loses 245, it's pretty likely to continue out down to 230. So there you have your low and your high, and this is largely how I trade most things. Is I'm looking at that. I'm looking at price to react to the being above or below levels relative to the positioning on the chain.
Yeah, I think you nailed it. I mean, the concentrations of Vana at 280 and 300 stand out to me. If I were looking for a place to put, those to me stand out. If I was to assume anything about the market, I'd assume those are sold calls. So I would probably, if I was targeting sold calls, I mean, you may be a little late, but I would probably be looking at those. But going forward too, I'd be looking at potentially, since we are reaching consolidation on the S&P 500 and Apple has a lot of beta. I'd probably be looking towards the put side for buy rights more than anything else. There's a decent amount of negative gamma at 240 and 250. And so I'd be looking at those to see if I can get a good entry on those if I was trying to do buy rights on it. So, yeah. JFresh, you got anything on Apple?
It's way overpriced.
If you look at PEs, things are a little different. But purely looking at options, I mean, with just taking it from an options perspective, I mean, that's kind of where my head's at. Question number 7. Is this the tool you use most? I mean, I use all the tools fairly equally personally. But this is one that if I find something interesting, this is the tool I go to after that. Like if I want to dig in, like, oh, a stock just, popped above Gamma Max, I'm looking at this tool. All right. This is the second or third tool I go to if things are looking weird on a stock for sure. Or something I'm just tracking really closely and I want to make sure I have a really, a gourmet or a boutique position on, I would use this to try to curate that position as best I could, personally. I don't get a lot of opportunities, but when I do, me and my Fubo. Yeah, I'll go with this. Question 8. Negative versus positive net delta on this chart gives kind of the same idea, right? As in the pressure depends on the net amount more than the polarity. Ooh, this is a good, I think this is a good question. So net delta and net gamma, right? You take all the bars, you add them up, you end up with a number. And that's what those net values kind of give you. And what these give you is more of like one of them is sort of like looking at the average temperature of the US, and one of them is looking at the temperature of, Minneapolis, let's just say. It gives you an idea of the locale you're in and the environment of that locale. So for gherk, that's why gherk uses this a lot for day trading, is that it gives you an idea of the short-term fluctuations in price and how they're going to behave and how to sort of adjust your positioning around around it and be able to find those good entries and good exits in the short term. You could even do it in the long term too, but it's when you're near these strikes, right? They will have an outsized effect on the price action of a stock, right? They'll reduce volatility, they'll increase volatility. It all depends on your proximity to them as well. So if you may have a shit ton of delta exposure on a stock or a shit ton of gamma exposure on a stock, but it's all concentrated at a spot where it's not really going to change. So you can't really glean as much in the micro sense from those aggregate values, and that's where this comes into play, is you can gauge what's sort of happening on a micro level from this. Anybody got anything to add to that, or can I move on? I'm kind of blasting through these things.
Blast away, sir.
Yeah. That's I'm fine with the way you answered that one.
Yeah, I mean it's really just it's a magnifying glass, right? And it should be used as such.
Yeah.
All right, number 9. Is there any major difference when looking at the Greeks with an index versus an equity? I mean, we briefly
Yes.
covered it. Yeah.
Yeah, there are. Well, you have differences in how equity volatility behaves versus index volatility. You also, equity positioning tends to be longer dated. So there's usually a lot more effect from delta than there is just from gamma. And so, SPX is driven by the 0 DTEs, as are most SPY, QQQ, IWM. Those are all heavily driven by their 0 DTEs. Their positive gamma environments, are additive to, they in positive gamma environments. You are getting a lot of dealer pinning. You're getting a lot of price stability. You're getting lower volatility and cheaper options. Whereas with equities, it's the inverse of that. The price goes up, vol goes up, volatility gets. You get more volatility as price rises. Versus indexes where you get more volatility as price falls. But equities are kind of, that aspect of it kind of works both ways. Like in a negative gamma environment, equities also pick up volatility, but they pick it up on the other side of the chain, and things kind of have to shift around for that to happen, because of the way portfolios are managed and how the NAV expression kind of comes into existence, because equities are very much, all puts are bought, all calls are sold. They follow that tenet much more closely than indexes do. But as we start to see equities shift away from longer dated, like weekly and monthly options chains, and we start to see, I believe several of the Mag 7 already have multiple expirations per week. We will start to see some of the effects that we see on indexes on equities. And since they represent such a large portion of the index, it kind of makes sense that we're going to see that shift occur over time.
My thoughts on that are yes, but there's a caveat in that indexes are European style, so because they're cash settled, there's a little less risk to assignment, right? Oh, you cash settle and that's the end of it. But with equities, you cash settle and you end up long. So the short dated, the ultra short term chains we're gonna end up with. My anticipation is that we will end up seeing institutional positioning around those ultra short term strikes, and then a very small amount of degenerate Wall Street traders bets on those dates. But these will be very large holders of the stock, whether long or short. hedging those positions in the ultra short term for the weird derivatives and things in their own position, rather than say SPX where they're doing things like hedging beta. That's my thoughts on that. Although over time, it may shift, but I think at least in the short term, like 1 to 2 years, I think that's primarily how it'll be traded on the largest position sizes. But I could be wrong, and we may just see everybody who's anybody just saying screw it, margin risk to the moon, right? So, but yeah, I completely agree with what you're saying. The indexes, because they are cash settled, because they sort of serve as this standard that you compare your individual equities and aggregate equity holdings to. They tend to be traded differently than an individual equity, where you're looking at more things like, how can you get this individual equity performance more in line with an index? All right. Jay, you got any? Yeah. Next.
I'll tell you when I have things to say. You're doing a great job.
Yeah, he'll just interrupt like I do.
Yeah.
I'm down for that. Okay. Gravity analogy was absolutely money, but why would we assume the opposite? Okay, we already hit that up for the follow-up. Is that only for indexes or specific equities? I mean, we just assume it across the board. It works. So, and this, once again, back to gherk's, explanation as to why we use the naive assumption, is like, it's falsifiable, and it's testable, and it doesn't change, and it is what it is. It tells you what it tells you. There's no attempt to try to add flavoring or spice or seasoning to the measurements that we're taking. We're just taking them at face value and showing you what it is. So that's what we're here for, is to just tell you how it is, rather than try to tell you what we think, right? Okay, next question. When new features? Ooh, that's a really, really good question. I mean, we have something showing up on a screen that's really, really cool, and we're about to start arguing a lot about how to have that show up on your screen. So I'm gonna give it 6 weeks personally. It may be longer, it may be shorter, but
first place it'll appear is on my stream, because I'm gonna play with it.
Yeah, gherk's got to shill it to the pores first. No, we're gonna have some arguments about it first. I mean, what good would a new feature be if we didn't end up releasing it and hating each other at the same time?
That's correct.
And then we have another.
That I'm envisioning it as the correct way. You're all wrong. You will eventually see what I see, and it will drag you to that conclusion, and you can make it as painful as you want, I guess.
Oh no, this new feature. I mean, anybody in the Discord has watched JFresh shit post his predictions and be, mostly right. It's one of those features. This one that's coming.
Let's
up
not
really, really
let's
good.
not combine JFresh shit posting predictions and any Gammastrike feature.
That's true. That's
JFresh has a long.
Also says we're crashing on Monday every month or every Sunday.
Yeah,
we
JFresh has a
crash on a Monday.
That is, he is not wrong. We have actually proven that.
He's testing the broken clock hypothesis.
No, we're gonna crash on a Monday.
It has to be a Monday.
Okay.
So it's when people are least hedged.
Oh yeah. So new feature, it's going to be pretty soon, and the next two features that are coming out, they're kind of the features that are going to be the features to end all features in terms of giving you that look into what the market is doing. They're truly beautiful. I've had my shot to look at them, and they are extremely powerful, and I'm just shocked that gherk is letting us release them. It took a lot of unspeakable acts of depravity, but
shut up. They're just normal tools that are not that special.
Okay.
God
Okay,
damn
fine.
it.
We'll let them discover it.
Yeah, I'm just gonna. I'm not gonna tell. I'm just gonna put it on the stream and tell no one about it. Remember mustard?
Oh yeah.
Just like
fucking
that.
mustard.
Yep. I'm just gonna put it on the screen like mustard and let people speculate as to what it means.
Okay, I'm down. Moving on. Question or whatever. Were neutrals discussed with respect to market maker positioning? They were.
Yes,
I know that Delta Gamma
very
Vega,
heavily in the last one.
Oh, we spent entirely too much time on it. I
Yeah.
know that Delta, Gamma, Vega, those are all separated with slashes, impact dealer positioning, and that's something I've always been a bit fuzzy on. Would love a bit more clarity on relating the two. The GS docs I've seen discussed more so how they are computed relative to the general market positioning, but not so much specifically dealer positioning, I think. Okay, so I think this person is a little unclear on this comes down to, I think, a fundamental understanding of delta, gamma, and vega for what they are. In terms of dealer positioning versus general market positioning, what we provide in terms of data is just kind of a two sides of the same coin in that respect, but delta and gamma and vega all impact dealer positioning slightly differently. Delta and gamma are sort of, once again, two sides of the same coin, whereas vega is a different thing, right?
Yeah.
So yeah, so I mean vega, so let's just go through them one at a time. Delta is the sensitivity of an option, like the price of an option contract, to the change in the underlying price of the stalker or index, right? So if you have a delta of 0.5 on a stock and the stock goes up by 1%, you expect that stock to go up by 50 cents. Gamma is the change in delta with respect to the change in stock price. So with gamma, stock goes up by 1%, and the gamma is like, let's just say it's 0.01. You expect your delta to go from 0.5 to 0.51. Vega is the sensitivity of an option contract price with respect to IV. So if IV goes up by 1% and you have a Vega of 2, you would expect your option contract price to go up by $2. So, and that's, Vega is a much more abstract concept, and it's much easier to discuss in terms of Vana, because Vana is the amount of delta that your contract will change with respect to a change in the underlying stock price, or sorry, with respect to a change in the option contract implied volatility. So if your option contract implied volatility goes up by 1% and it has a Vana of, let's just say, 0.05, and you have a delta of 0.5, your delta is going to go from 0.5 to 0.55. So Vana has an effect on delta, right? Or Vana is a measurement of the effect on delta. But in terms of impacting dealer positioning, ultimately all roads lead back to Rome, which in my mind is delta. Vega, on the other hand, is that's where you get into the concavity discussion that I like to leave to gherk because he does a good job of explaining it. But in terms of dealer positioning, in my small brain, all roads lead back to delta, and how things affect delta is really where my mind is at. So you can, when you look at our Greeks by strike and you look at gamma and you look at Vana, right? These sort of give you an idea of how that delta hedge is going to change as the equity price moves up and down, and as the outlook on the equity or index, tightens or expands. So, and then charm too. Charm tells you sort of how that expectation changes over time. So that's another one to sort of look at. But ultimately, what it all leads to is a sort of like a toilet getting flushed, and you're sort of describing that vortex of water down the toilet bowl. Did I do okay on that?
You did.
The toilet analogy, is it as good as the gravity analogy?
Yeah. Toilets, black holes, same stuff.
Ultimately, it's just money getting lit on fire by people in tree bets. So, flushing down a toilet, getting stuck in a black hole, and spaghettified, however you want to think about it. Okay, next question. Trying to wrap my head around dealers selling into a move in a positive gamma environment. Shouldn't dealers be buying as price moves up since delta is increasing? Oh, spicy question. It's not.
I
that
think we
spicy.
hand this one over to JFresh, and he can stop doing whatever he's doing. You want to answer it?
I've had plenty of I've fought this in because this is one of those things. I mean, when you're taking physics courses, especially, or whenever people say, okay, what does your intuition tell you about this situation? And your head right away goes, well, this is going to happen, right? And so it's definitely one of those questions where, and then the professor, whoever, goes, well, you may think that, but you're not correct. JFresh, if you want to take it, you can. Or I can.
We're talking about 14, right? The positive.
Yeah, 14. Yeah.
Yeah, so just if you think about what positive gamma means, right? So let's just think about the call side, that it's positive gamma because of what calls are doing. So for it to be positive gamma, the calls have to be sold by the market participant to the market maker, which means the market maker is long calls. Okay? Which means that their risk is that they are going to receive shares. And so they can hedge away that risk by selling the underlying. So that's just, and let's say the delta starts as 0.5. You sell 50 shares and you're hedged. Now the price of the underlying goes up. And now the delta on that contract isn't 50 shares, it's 75 shares. But he only owns 50. Or sorry, he's only sold 50 shares. Now he has to sell 25 more to say delta hedge. So price went up. And his delta, he had to sell as the price was going up. And that's because when the market maker owns those contracts, they are positive gamma. So it doesn't, you can do the same thing with sold puts. You start at, say you're at negative 50 and negative 50 delta, which means you had to buy 50 shares. If the price goes up, you go to negative 25 delta because you increase gamma. Gamma's positive for all bought contracts. So you're adding 25 shares to negative 50, which goes to negative 25. Okay, so they have to sell. Yeah. So when you have sold contracts to a market maker, that means the market you are short gamma, the market maker is long gamma, and they must do the opposite of what price. They must act in the opposite direction of price. If price goes up, they sell. If price goes down, they buy. For both calls and puts, all that matters is where they bought or sold.
Yeah, I mean, there is an order. There's a fun thing that you'll get really good at as you gain more and more experience with this platform or with options in general, and there is an order of operations to thinking about the direction in which hedges work, and kind of just the way JFresh walked through how you sell the call, making the dealer short the call or long the call, and then the dealer is long the gamma, and you're short the gamma, and then thinking about how that hedge interacts. You can do that with everything, and this is a very important and kind of one of the final steps in learning trading, how to trade options and how positioning in the market affects price.
I think trading around the options market is a better way to put that.
Yeah, I guess so. But yeah, I mean, just remember the key to all of this is that gamma is the rate of change in delta. So when gamma is larger, so when the total exposure for the market maker of positive gamma is significantly greater, then the change in delta for the same move in spot becomes larger. So if you're in like a fairly neutral gamma environment and the market moves up 5 BPS, there's not like a very big change in delta. But if the market maker is sitting on top of $50 billion in gamma exposure and gamma moves up a few BPS, their shift in delta in their book is very significant. And they need to sell that delta as they become over hedged. So they have to hedge the upside very, very quickly, but then they find themselves too exposed to delta, and they have to shed the delta. And that's why the large bars of gamma act as resistance, because the market maker has now hedged all of that delta on the move, and when they get to the kind of the middle of that big bar, they don't need all that delta anymore. And so mechanically they start to sell that delta, and that's one of the and so that causes the market to pull back because they're selling. The bigger the rally, you'll see this a lot. The bigger the rally, kind of the faster the snapback. So if you get a huge move in spot like we had today, we almost immediately dropped like $50 after moving up 100. And one of the reasons for that is you've created so many sellers at the top of that move. After everybody's picked up all of that delta, now everybody's massively overexposed, and they start dumping it really, really fast, and so you get a very quick pullback. I mean, I feel like that was a pretty good example earlier today of what I'm talking about. Because I think we have it here on the live data. We could actually look at it. You can see that during that period where the market rose really, really rapidly this morning. This is Apple. I don't want to look at Apple. I want to look at SPXW. You look at what happens with delta. See how everybody gets like very look at the delta relative to that over that period of time where the exposure is, and see how it kind of snaps up really hard here. And you see this big move in delta exposure. Then they shed it, and then that's why we pulled back to like 56, like 65.60 from a test of over 6,600. Which is almost a $50 move back to the downside, because they just had too much delta on their book. And so some of these things are the understanding of them, they're mechanical. They will occur regardless of the market conditions because they have to occur. And knowing where those points are really helps give you a bit of an edge, I think.
Yeah, I think when we move to the live data tool too, and the cool thing about what live data does for you is it allows you to test your hypotheses about a lot of these Greeks by strike things you've got swirling around in your brain. You can watch them get proved and disproved in real time. It's pretty incredible for that. But with that, I think that we've gotten through all of the questions. So with that, I want to say we're taking off this Sunday for Vol Stars to just kind of hang out and get absolutely trashed and do whatever we do.
There's a holiday
or something.
Yep.
Yeah. So we're gonna take it off. But next Vol Stars is gonna be coming the next Sunday. So you got questions, anything like that, anything we've covered, feel free to ask us in gherk's Discord or on the comments of this video or the stream on X or wherever it is that we're streaming this. Feel free to ask. We had a few questions that we thought were better suited for Vol Stars already, so we're gonna hit them in Vol Stars. So, just feel free to. Oh wait, we got another question. Oh God. Anyways, ask your questions once this thing ends. But we got another question. You guys want to go for it?
You talked for so long. Another question popped up.
Should I just keep doing that so we're here all
The
night?
positive gamma means that there's more sold options than bought options. Yes.
There you go.
No.
Yes.
And it's all in the
Yes.
docs.
It's in the docs.
Yeah, actually-
Gammastrike.com/docs.
Yep. /docs.
Sorry, /docs.
Try one slash. If that doesn't work, try the other one. There's only two.
It's true. And they're all the same directional slash. So just try all forward, try all back, to see what happens and let us know if you run into a bug. But yeah, so anyways, ask away on these in the comments of these things, wherever you're watching this from. And we will get to them on Vol Stars if we have time. And we've already got a rolling tally of a few for the next Vol Stars. We'd love to add to it. And then, stick around for the next one of these in 2 weeks where we cover the volatility page, which is going to be a ton of fun.
Yeah.
That one's great.
Oh, yeah.
So
It'd be great if we could have a beta version of the tool that you're working on, Dork, for that page.
I
even if
actually
I got it done in an hour. It would
at the tail end of this, I'm going to save us something awkward in the future. And I'm going to say, let's cover the gamma curve real fast.
right now.
Yep. Because
I mean,
it's
we
technically the same thing. So this is what you're looking at on the other page for the full chain displayed as a curve. And that way we don't accidentally have an episode of Roundtables where I say just that and then we end the stream.
I wanted to do that one. A 30-second roundtable sounds fun.
No. They will all be 3+ hours carrying us deep into the night. Wait till we do scanners all at once.
Oh my God. We're going to be up until 3 a.m. My time, 3 a.m.
Jesus, yeah.
Watching the sunrise. Yeah, gamma curve's cool. Yeah.
So it's this. Hold on, I'm going to show everyone real quick so no one's confused. It's this, the whole thing, like that, but as a line.
Pretty much.
Yep.
So you look at it. It's a cool thing. This will give you an idea of how aggregate gamma changes as spot moves around. So it's a nice tool for finding out.
You tend to get flatter markets when it's flatter, and you tend to get more ranging markets when it's steeper.
Yeah, for sure. So this gives you an idea of not only the environment you're in for gamma, but also just the intensity of said market, I would say, which is the steepness of that line, which you could consider speed, but let's not get into it.
And that's
it. For that?
That's it. So
trust me, JFresh, I want to fight with you right now about it, but we're in front of a bunch of people, so I can't. No, I can't. Yeah. No, I don't want to do it. No, let's do it later.
Do it.
All right.
Do it.
I want to be naked. No.
Do it. Just say your piece, and I'll end the stream before you can respond.
No, I don't want to. Fine. I'll just say it right now. Gamma Max is speed neutral. There we go. Let's end this.
Nope.
Penis.
God damn it. Son of a bitch. Well, now I'm mad at him, too. I didn't know he was going to say that.
All right. Thanks, everybody.
Thanks for tuning
Thank you,
in,
guys.
guys. We'll catch you later.